In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analysts' predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. Today we are going to look at Estee Lauder. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share. This is where we take the net income and divide it by the shares outstanding. For Estee Lauder, this is minus 80% for the trailing 12 months. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health, and prefers companies that can generate substantial free cash flow. And here we can see, Estee Lauder have hit our 10% free cash flow target, as it is a massive 83%. Then we come to the next pillar, which is revenue. And this tells us how good the company is at generating income before deducting expenses. Their revenue is at minus 3% for the trailing 12 months. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value is minus 9%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are just at 1% and 4%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. It would take Estee Lauder nearly 7.5 years to use their free cash flow to pay off the debt. At present, with the information we have gathered, it tells us that Estee Lauder's key pillars are not looking great so far, but let's find out more. Help support the channel by tapping the like icon, if you have found the information helpful, and click on the notification bell to get alerts about my next videos. Now we will focus on other key pillars which help define an excellent business. So let's look at the gross margin, which is the amount of money a company retains, after incurring the direct costs associated with producing the goods it sells, and the services it provides. This is currently at 72%, which is good, as we like to see the gross margin at or over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is 10% and is below our target of 14%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 5.69% this looks good. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is minus 1%, with the lowest point being this year at minus 9%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 21%. In the comments section, I've included a link to the investors page and the annual report, if you want to check it out for yourself. Now let's look at past historical performance, to give us a better understanding of the company's successes and failures. Looking at the chart, we can see that in 2019, their stock price was about $190. But during the pandemic, their share price dropped as low as $150. After that, the company's share price soared to about $370, but during the 2022 market dip, they fell to about $200. Although, we can see they had a short recovery, they have repeatedly fallen. Now their share price is as low as $63. Looking at the overview, we can see the current market cap is $22.88 billion. They are currently generating $15.45 billion in revenue. Their net income is $203 million, and they have 358.98 million shares outstanding. At present, their earnings per share tells us that for each share of stock, the company is generating 56 cents. Their PE ratio is 113.46, which is far greater than the S&P 500 average of about 28. The overall consensus is hold. However, analysts are forecasting between 20 and 90% growth from 2025. The average price target is about $94. Now I am going to show you how to create a valuation. So, I will use their current earnings per share of 56 cents. Now I use a combination of the past growth and future analyst predictions to create the estimated earnings per share growth. To create a valuation, I'm going to give Estee Lauder a 10% growth rate. Then, I am going to give them an estimated PE ratio of 100. After that, I will project these numbers forward by 10 years. Then I will set the return I would like to see from this investment to just 5%. This then gives me an estimated future stock price of about $145 per share, for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $89. Then we apply a margin of safety. At 25% it gives me a buy price of about $67. It all depends on your personal view, and outlook for the company, as well as the return on the investment you would like to see. I have previously been invested in this company, but like many other underestimated the problems the company were dealing with. However, could this company have greater potential in the future? Please consider sharing this video with someone you think will like it, and click on the link above to learn how to create your own earnings per share growth model. The return we would receive if we bought at our 25% margin of safety price of about $67 and sold in 10 years' time at our estimated future stock price of $145 would be 116%. But this is dependent on our assumptions for the company being correct. In addition, Estee Lauder's annual dividend is $2.64. And their payout ratio is unsustainable at 475%. The dividend growth for the company is 10.73%. If you have enjoyed this video, let me know in the comments section. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Estee Lauder scored just 4 out of 12. So I will give them a cross. As for the past results, over the last few years their share price has been trading downwards and has fallen 67% in the last 5 years. Here, I will give them a cross. Analysts are signaling Estee Lauder as a hold, although they are predicting growth between 20 and 90% over the next few years. Therefore, I will give them a check for this. Using the EPS growth model I used earlier on, we created a buy price of about $67. However, this was at a very high PE ratio and my return was just 5%, so I will give the valuation a cross. According to Morningstar, Estee Lauder have a wide moat. Therefore, I will give them a check. My final overall rating is 2 out of 5 stars. I have given this a category E rating within my own stock watch list, but could be interested in them if their share price was to halve. Thank you for joining me during this stock analysis video, and I hope to see you in the next one.